Advanced Financial Modeling, Topic 22, Cost of Capital, Section 6. Understand optimal capital structure and how it relates to WACC. So we can think about what is the optimal capital structure, or we can think about as simply the DD ratio of a firm. Well, one way of thinking about it is if I were to graph, say, the weighted average cost of capital of a firm and its DDE ratio. One theory is that if a firm starts off with, say, zero amount of debt, it might have a WACC of, say, this level here. So that would just be their CAPM, cost of equity. In theory, adding a little bit of debt to a firm that's, say, very safe to begin with, say if Walmart had zero debt, adding a little bit of debt is probably going to lower their WACC as they take advantage of the tax shield on interest payments. However, and also think about the lower your WACC is, the more valuable the firm is. Remember, when valuing the stock for Walmart, we're going to take the present value of free cash flows discounted at WACC. So the lower the WACC, the higher the value of the firm. However, at some point, you have enough debt that you materially affect the risk of the firm. There's a material risk that in a downturn, the firm could have some distress, either related to, say, losing employees or exorbitant cost borrowing rates. At some point, having too much debt is going to raise the WACC again. So the question is, what is that optimal DDE ratio, the optimal amount of debt to use? And so that's what all firms are trying to figure out. What is the optimal? What I can tell you is firms that have very, very low business risk should probably have a little bit of debt to take advantage of the tax shield. However, firms that have enormous business risks tend to have no debt because they figure out we have so much business risk. Why layer on any financial risk, even if there is a small advantage to getting the tax shields? Now let's talk about, in theory, a little bit of debt should help, and debt should affect the weighted average cost of capital. Now, the evidence is kind of disappointing. The evidence is looking at some papers on people that have studied the relationship between WACC, firm value, and DDE ratios. There doesn't seem to be a lot of clear evidence that the DDE ratios actually affect the WACC at all. So maybe it's just perfectly offset. So as you increase your DDE ratio, you get the advantage of the tax shield, but you become riskier and your betas go up. Maybe it's just perfectly offset. So some of the evidence shows that actually the DDE ratio doesn't have an effect on WACC. So this leads to an interesting implication. If your DDE ratio in practice or empirically doesn't have an effect on WACC, well, why do all that effort in trying to compute the DDE ratio, the cost of debt, and getting the WACC? Why don't we just take the unlevered beta, plug it in CAPM, and call that my WACC? So that leads to an interesting alternative for a firm to calculate the WACC, its current WACC and the WACC of an individual project. Just take the industry unlevered beta for whatever investment they're looking at and just plug it into the CAPM formula. So there's my summary of how to calculate the weighted average the WACC for different projects. If the project is risk-free, just use the after-tax cost of debt. If the project has the same business risk, same financial risk, just use the firm's WACC. Same business risk, different financial risk, simply relever the beta using the new DDE ratio. If it's in a different industry, just use that industry's beta, unlevered by that industry's DDE ratio, and relever it by the firm's DDE ratio for that project. If it's a foreign project, maybe we just add the sovereign risk premium to KE and KD. However, we now have an alternative now, and that is, since the evidence says that DDE ratios don't matter, maybe I just take my unlevered beta for that project, in other words, whatever industry it's in, and plug it in the market risk, plug it into the CAPM formula. So that is optimal capital structure and how it relates to WACC.